You don't need a fortune to begin investing. With just $100 and a simple, repeatable plan, you can start building a real habit and see progress over time. Today, I'm breaking down a practical, keeps it simple method to start investing with $100 and keep it growing. It's not flashy, but it's something you can do again every month without stress or guesswork. First, decide your goal and your time horizon. Are you saving for a retirement long in the future, or building a small safety net you can rely on? The answer shapes how you choose investments and how often you check your plan. If you aren't sure yet, a long horizon is a safe default. It gives you room to ride out market ups and downs. Next, build 3 small buckets that fit inside that $100 and your monthly habit. Bucket 1 is learning. Bucket 2 is a cash reserve to handle short-term needs or opportunities. Bucket 3 is the actual investing fund. This structure keeps you from mixing too many things in one pot and makes the plan easier to follow. For the initial $100, split it like this. About $60 goes into a core investment, a low-cost broad market ETF that covers a big chunk of the stock market. About $20 goes to your learning budget, books, courses, or even a paid newsletter that helps you understand investing better. The remaining $20 stays in a plain savings or money market style reserve you can access quickly if you want to pounce on a new opportunity or cover a small emergency. Choosing a core investment is simple if you keep it broad and cheap. Look for a low-cost ETF or index fund that tracks the total stock market or a very wide market like the S&P 500. You don't need to pick individual stocks to start. In fact, that often adds unnecessary risk at this stage. The key is low fees, broad diversification, and a fund that you can keep for many years without constant tweaking. Fractional shares are your friend here. They let you buy a slice of a fund even if one share costs more than your $60. That means your $60 can be spread across a couple of broad funds if you want a touch of diversification from day one. If you're not sure which fund to pick, start with a single broad market ETF and add a second fund later when you're more confident and the habit is solid. Dollar cost averaging is your friend too. Instead of waiting for the perfect moment, set up automatic monthly contributions. A simple plan is to add $25 every month to the same core investment. If you started with $60 today, you'd invest another $25 each month and watch the balance grow as you continue to add. Over time, this smooths out the price you pay and reduces the risk of putting all your money in at a single bad moment. Expect to hold investments for years, not days or weeks. That's where the real gains come from. You won't become rich overnight, but you'll gradually grow your money as the market trends upward over many years. The habit of regular investing matters more than chasing the latest hot tip. What about the second bucket, the learning budget? Spend this money on something that genuinely improves your decisions. A good book on investing, a short online course, or a reputable newsletter can punch above its weight. The goal isn't to spend a lot of money, but to invest a little in your own knowledge so you make smarter moves down the line. If you ever find a course that promises fast riches, walk away. Real wealth comes from steady, informed choices, not quick bets. The third bucket is your cash reserve. This is not poker money. It's money you can access without needing to sell investments at a bad moment. A small emergency fund is practical, and it keeps you from drawing down your core investments when life throws a curveball. Keep this in a high liquidity account so you're not forced to cash out at a bad time. A quick note on fees and accounts. Start with a broker that has no trading commissions and supports fractional shares. You don't want tiny fees to eat into your early gains. If you can find a platform that offers a simple dashboard and straightforward tax reporting, that makes it easier to stay consistent. If you already have a high-interest debt, consider paying that down first. Reducing debt can often be a higher return move than investing small amounts in the near term. As you grow, you'll want to add 1 or 2 more ideas to your routine. One is diversification that goes beyond one fund. If you can, add a second broad market fund that covers international companies. It doesn't have to be complicated. A simple mix like 60% US-wide and 40% international can provide broader exposure without becoming unwieldy. The exact mix isn't sacred. The point is to avoid putting all your eggs in one basket too early. Another habit is to review every quarter with 3 simple questions. Did I keep fees low? Am I still investing regularly, regardless of market moves? Do I understand the core investment I own? And could I explain it in plain English? If you can answer yes to those questions most of the time, you're building a durable habit rather than chasing noise. Let's walk through a small example to make this feel concrete. You start today with $100, you put $60 into a broad U.S. stock market ETF via fractional shares, $20 into your learning fund, and keep $20 as a cash reserve. Each month, you add $25 to the same ETF. After 6 months, you've contributed $60 plus $150, totaling $210 into the core investment. If the market has grown modestly, your investment may be worth around $230 to $240, accounting for a bit of price movement. You've also added another $25 of learning value and kept a small buffer in case you want to study a new topic or seize a tiny opportunity without touching your core investment. You won't see dramatic results overnight, and that's deliberate. The math behind wealth building through investing with a small, consistent amount works because time and discipline compound. Your job is to keep showing up, contribute regularly, learn a little each week, and protect the core by avoiding unnecessary churn or big bets. The habit itself becomes your main asset. A few practical mistakes to avoid as you start. Don't try to time the market or chase hot tips. Markets move up and down, but one well-chosen, low-cost fund tends to win over many years. Don't ignore fees. Tiny charges add up and can shave years off your returns. Don't overcomplicate the plan with too many moving parts at first. Simplicity breeds discipline, and discipline is what makes the plan work. If you're worried about whether $100 is enough, remember this. The value isn't just in the dollars you invest today. It's in the habit you're building. The money you add next month becomes part of the same plan, and the month after that too. Your future self will thank you for sticking with something steady rather than chasing flashy schemes. Over time, you can adjust the mix as your life changes. If you land a raise or pay off debt, you can increase your monthly contribution or shift more money toward the core fund. If you learn more and feel confident, you might add a second broad market ETF to broaden your diversification. The exact numbers aren't as important as staying consistent and keeping costs low. To summarize the core ideas in one simple framework, invest in a broad, low-cost ETF with fractional shares so you can own a piece of the whole market. Start with $60, add $25 each month, keep $20 in cash or a fast access reserve, and allocate $20 to your learning budget. Keep it simple, keep costs low, and keep adding to your plan every month. If you do that, you'll build a money habit that compounds far faster than you expect. If you found this approach helpful, tell me in the comments what your monthly plan would look like. Do you prefer a single broad fund, or are you curious about adding a second fund later? Share that with us. If you're ready to get started, hit the like button to show you're in. Subscribe to follow along as we break down more practical steps like this. And please post any questions you have below. I'll reply and help you think through your own plan.